This segment sponsored by Foster Financial. Welcome to Money Monday with Foster Financial, where we provide you with holistic financial advice from Caleb Doan, the Vice President of Foster Financial. Good morning, Caleb.
Good morning.
Welcome back.
Thanks very much.
Yes. Okay, so we're continuing our conversation that we started on the last Money Monday, which was all about the market and the market corrections and how that can be beneficial to consumers. So kind of give me a highlight on what is a market correction, and then we'll go from there.
Yeah, so I mean, a market correction is typically, a bad thing, right? It's that it's a 10% drop from a recent high in the stock market.
Right.
So we never like to see the stock market go down, but of course that's part of investing. The stock market does not always go up. There's going to be those fluctuations. So I mean, as financial advisors, we take a look at that and say, all right, we know there are going to be periods where the market is dropping. Are there ways that we can benefit the clients in periods like that? And so we talked last time, I think, about non-qualified variable annuities, how sometimes it can give you an opportunity to maybe get out of those if they no longer fit in the financial plan. Today, what we'll talk about is another opportunity when the market drops, and that is providing an opportunity to diversify away from maybe a really highly concentrated stock position that somebody has. And so when the market drops, let's say that somebody has, bought a bunch of Apple stock, a few years ago and it's appreciated a lot. Maybe they feel like they can't sell out of it because they would have to pay a ton in capital gains taxes. Well, if the market drops, maybe it reduces the amount of capital gains that they would need to pay, and so it can provide an opportunity to reposition some of those assets.
Right. And one thing I love to highlight is just the fact that this is something that applies to most people. A lot of times when you hear stocks, it's like, oh, I'm not, savvy in trading and I don't, really know what the market's doing. But if you have a 401k, if you, have an IRA that has some type of investment, value in it, all those other retirement accounts are really impacted by what the stock does. Yeah, and we're seeing that right now in the current market, influx or deflux. Specifically, can we just pivot for a second and talk about like the impact of what's happening in the world, like with Tesla, for example. What's happening with Tesla and Elon's stock is going down on that car. And a lot of people whose companies invested their 401ks in that stock are impacted. And they're like, wait, because I think it's a lot of federal employees. So can you kind of break down that scenario so people can understand tangibly how it connects? Yeah,
I mean, I think probably what, some of the reports, talking about how federal employees might have some positions in Tesla, a lot of times when people have positions in Tesla, it's more so related to like an index mutual fund or something that they're invested in, like the S&P 500, and of course Tesla is in the S&P 500. So I'd say it's relatively uncommon for somebody to have specific, direct Tesla stock in their 401k. Usually 401ks have really pared down investment options, and it's these bigger mutual funds. But if Tesla moves, then it moves the S&P 500, which people are invested in. So obviously it was a very wonderful thing for the last 10 years with Tesla going up really rapidly. So far year to date, Tesla has gone down a little bit, so it certainly impacts those stocks. But Tesla is another good example. If somebody has an after-tax brokerage account and they own a lot of Tesla stock and it's done great over the last 10 years, that's wonderful. Maybe it has a lot of capital gains on it. And so maybe they've been looking for a way, okay, how can I diversify away from this? I still like it as a company, but I don't want such a high percentage of my assets in Tesla. Year to date, if it's gone down, it could possibly be a good opportunity to reposition. And it doesn't mean we're selling out of it and going to cash, because then you're not able to take advantage of a potential recovery. It would mean selling out of a certain position and going into something else that we still think has the same ability to recover with the market, but now we're not solely tied to that one stock.
Okay, and when you say that people may find it risky, just if they have to pay, are you saying that because of the capital gain, which is something that is the amount of money that they receive as interest, right? Or like
the capital gain, that'd be the growth
on
what they're
on the money. So what they invested, what it is now, all that money in between is capital gain. They have to pay a fee on that, or they have to pay taxes on that if they transfer out of that stock option?
Yeah, in like an after-tax brokerage account, if they sell out of that position, it now becomes a realized capital gain. And a lot of people are in the 15% realized capital gain tax bracket. And so typically they owe 15% on that.
Okay, so I think we talked about this before, but it's best for people to utilize or tap into that capital gain when they are at closer to retirement age because they're in a lower tax bracket that they're impacted?
It kind of depends. I mean, there are a lot of factors of when to sell out of a certain position. There's, diversification reasons. There's if just somebody needs the money, then it can be a good time to sell out of it, depending on what the stock has done, can kind of determine. But yeah, certainly if your tax bracket has changed, if you're in the 22% federal income tax bracket, your capital gains tax bracket is 15%. Okay. If you're in the 12% federal income tax bracket, your capital gains are 0. Actually.
Ooh,
so if we know that somebody's going to be in the 12%, sometimes we wait until they're in that 12% bracket to realize capital gains so that they don't owe anything in taxes on that.
Okay, so what if someone is highly concentrated in stock? What should they do?
Yeah, I mean, of course, when the stock market is down, everyone wants to be more conservative or wishes that they were more conservative. If it's going up, they want to be more aggressive. So if somebody is highly concentrated in a stock, it's just a good idea to get a second opinion on it, take a look at it and see how exposed you are to the movement of that one company. You could have a ton of money in, a company like GE, 10 or 15 years ago, and it feels like it's great. But if that company then does poorly for the next 5 or 10 years, it can have a really big impact if you have a really high percentage of your assets in that one company. So it can always be a good idea to diversify, and that's where we can step in and help.
Okay, and then overall, when we're talking about the market correction, how can people actually save money during this market correction? Yeah,
it can be really avoiding some of those capital gains taxes. Obviously, freeing up a certain amount of a position now is slightly cheaper than it was at the beginning of the year if the stock market has gone down. But we want to be strategic with how we reposition that money. So that's how clients can save money overall, and then in the long term, be more diversified too.
All right, awesome. Caleb, I learned so much from you.
Thanks for having me on.
Talking stock with Caleb.
There we go.
Thank you.
Thank you.
And if you would like more information about Foster Financial, we'll have their website and their phone number listed below. You can contact them for a complimentary consultation. And I'll see you after the break. This segment sponsored by Foster Financial.